Well, Trump just threatened to cut off dividends and buybacks for defense contractors. Stocks tanked. Then hours later he floated a $1.5 trillion defense budget. Stocks ripped. So what the mew? Which is it, bullish or bearish? Look, if you're short on time or you don't trust some random cat on the internet, here's my quick 2 cents. This isn't a U-turn. It's a conditional expansion. More money is coming, but with strings attached. And there's a specific type of company positioned to benefit no matter which prime contractor wins or loses. If you choose to stick around, I'll show you exactly how this works in the next 10 minutes with charts explained. Hey, welcome back. I'm DataCat. And if you're new here, which statistically you probably are, because this channel is like, 5, almost 6 months old now? Let me give you the quick rundown. I spent years as an analyst inside a Fortune 50 company. Spreadsheets, building trash models, sitting in meetings where people use the phrase synergistic value creation. You know the type. Eventually I traded the corporate grind for, lasers and keyboards, hence the name. This channel is just me breaking down market events and ideas the way I wish someone had explained them to me when I started. No courses to sell, no Discord pump groups. Just a cat trying to make sense of the chaos. So your like and subscribe really matters a lot, to let my cat knows I'm not completely useless for not being out there, working, hunting for his food. Alright, let's talk about what just happened. So the defense sector had one of those days where you check your portfolio in the morning, panic check it after hours, and then you're just confused. Here's the sequence. First, Trump comes out swinging. He says, and I'm paraphrasing, he will not permit dividends or buybacks for defense companies until they fix their production speed and maintenance problems. He even called out specific names. Raytheon got singled out pretty hard. Markets did not like this. General Dynamics, Lockheed Martin, Northrop Grumman, RTX, they all dropped. And, fair enough. The entire equity story for defense primes has been steady cash flows, return to shareholders through buybacks and dividends. You threaten that, you raise the political risk premium, you increase uncertainty around capital allocation. Naturally, investors get nervous. Think about it from a fund manager's perspective. You own Lockheed because it's predictable, reliable government contracts, consistent payouts. Now suddenly the government is saying, actually, we might not let you return that cash. That's a major change in the thesis. So stocks fell. Makes sense. But then, and this is where it gets, let's say, Trump-style dramatic. Trump floats a $1.5 trillion defense budget target. That's like 60-70% above fiscal year 2026 levels. And suddenly after hours, defense stocks are ripping higher. Why? Simply because more budget means more awards, better pricing power, longer backlogs. Especially if investors believe the restrictions will be temporary, selectively enforced, or limited to specific contracts. So you had this whipsaw, down, then up, and people are confused. But here's what I think most people are missing. This isn't contradictory. This is a two-part carrot and stick strategy. The stick is obviously penalize defense contractors that are underperforming on delivery speed and sustainment. Restrict their ability to do buybacks and dividends. Pressure executive compensation. Make it painful to prioritize financial engineering over actual production. And the carrot is promise significantly more money, a lot more money, but condition it on reinvestment, plants, equipment, capacity, throughput. The message to industry is basically, we're about to spend a lot more, but you don't get to treat the DoD revenue as a pipeline to Wall Street while delivery schedules slip. Reinvest, expand capacity, deliver. Then you can resume payouts. That's not a contradiction, that's a conditional expansion. And here's the part that really matters for us as investors. How do they plan to enforce this? According to Breaking Defense, the administration is trying to operationalize this through procurement leverage. They are reviewing underperforming contractors and writing restrictions into future or renewed contracts. So it's not a blanket corporate law prohibition. It's more like, if you want DoD business, your capital allocation must support capacity and delivery. That's a very different thing, and it creates a very specific second-order trade. Okay, so let me walk you through this. If defense primes are being forced or strongly incentivized to reinvest into capacity, where does that money actually go? Think about what a factory needs to increase throughput. More machines, higher utilization, more automation inside cells and lines, more test capacity, better quality assurance, faster maintenance, repair and operations pipelines. The common bottlenecks are machining hours, repeatable assembly, quality control capacity, and yield versus scrap rates. The capital expenditure package to fix that usually includes fluid power systems, filtration, hoses, fittings, connectors, thermal management, actuation and motion control components, sealing, engineered components. The list goes down on and on. So the question becomes, who supplies this stuff? This brings us to the picks and shovels thesis. In this case, the shovels are the companies that enable factory modernization and capacity expansion. They're the toll collectors on the defense throughput build-out. One name that fits this profile pretty well is Parker Hannifin, ticker PH. I'd say over 40% return last year as a less common name compared to all the AI hype is pretty impressive. Now, Parker Hannifin is not automation software. It's the physical stuff that factories and platforms actually run on. Motion and control, fluid power, filtration, aerospace systems. If primes and Tier 1 or Tier 2 suppliers are forced to reinvest into capacity, the spend shows up in exactly the categories Parker dominates. And Parker has two shots on goal here. First, factory enablement, industrial motion and control components sold into plants being upgraded. Second, on-platform content plus aftermarket, aerospace systems content on aircraft and engines, plus recurring spares revenue. And here's the thing. This isn't a turnaround story. Parker already has long-cycle aerospace and defense momentum. From their fiscal year 2025 disclosures, they reported record sales of approximately $19.9 billion, strong cash generation and significant capital deployment. Their aerospace segment backlog rose to $7.4 billion too. So the defense throughput theme can be slow burn for Parker. They don't need an immediate step function to work. They can ride existing aerospace demand while layering incremental industrial capex demand on top. It's like being a cat who already has a warm spot on the couch, and then someone brings out a second blanket. You didn't need it, but you're certainly not going to say no. Alright, let's talk about the chart. As of Wednesday, the trend backdrop is still bullish. Price is above the 20-day EMA at around $887, above the 50-day SMA at $851.30, and well above the 200-day SMA at $728.57. The Golden Cross has been active for 133 days. Both the 50-day and 200-day slopes are positive. On balance, volume slope over 20 days is positive. Accumulation hasn't broken. But, and this is important, the last day printed a warning signal. Parker hit a new 52-week high intraday at $933.33, but closed at $908.39. That's a rejection. Bearish engulfing candle, gap and fade pattern. The close was about 2.67% off the high. Volume was only about 1.2 times the 20-day average. Enough to matter, not enough to call it capitulation. Momentum cooled fast. The RSI dropped from 72.8 to 61.8 in one session. That's a momentum bleed without breaking the trend. MFI stayed high around 76, which means money flow is still strong, but it can also mean the short-term picture is crowded or frothy. Average true range over 14 days is about $15, roughly 1.6% of price. Yesterday's intraday range was around 2 average true ranges. An eventful day, but not crazy. So what does this mean practically? 2 clean interpretations depending on your time frame. First interpretation, trend following viable pullback. This candle often leads to 1 to 5 sessions of digestion. Either price holds above 897 and reclaims 910 to 911, or it tags the 20-day EMA around 887 and bounces. Bullish confirmation would be the next 1 to 2 sessions holding above 897 with a reclaim of 910 to 911, especially if volume normalizes and wicks shrink. If you're more aggressive, a reclaim entry would trigger when price reclaims and holds 910 to 911. The idea is that this repairs the failed move and can trap shorts or reload longs. If you're more patient, the buy the dip zone is around 885 to 890. That's confluence between the Fibonacci 0.5 level and the 20-day EMA. In strong uptrends, the 20-day EMA is often where institutional dip buying shows up. Price has been above that average 100% of the last 20 days, so the first tag could be meaningful. Now obviously this is not financial advice, but speaking of reading setups, some of you might remember about a month ago I made a video on the Venezuelan oil tanker situation. I mentioned how energy names like Exxon and Chevron could benefit, and I also flagged a more speculative play, Frontline PLC, as a potential winner if chaos escalated further. Well, then we suddenly have Maduro being captured. Oil prices dropped, and energy stocks surged, like 10% in some cases, Frontline included. So, sometimes the cat gets lucky. But this kind of chaos is more than what I originally expected. And that's exactly my point with all the research I've done. At the end of the day, it still heavily depends on external factors that I couldn't anticipate, and reality often hits harder than our fantasy in both ways. Investing in stocks that don't follow the major market narrative, aka not AI, can be both a safer and riskier play at the same time. Safer because you're not crowded into the same trades as everyone else. Riskier because you're betting on catalysts the market isn't pricing in yet. Remember, I'm just a cat on the internet. Do your own due diligence. I'm just showing you how I look for opportunities outside the obvious, and how I'd read the setup. So, what could go wrong? The 1.5 trillion budget target requires congressional authorization. Budget experts are skeptical. There's a real question of whether the defense industrial base can even absorb this level of spending. Supply chains, labor, raw materials, all of those are constraints. There's also enforcement uncertainty. How strictly will these payout restrictions actually be applied? Which companies count as defense companies? What are the thresholds? These questions aren't fully answered yet, and Parker specifically trades at a premium valuation. If the broader market sells off, or if defense sentiment reverses, that premium can compress quickly. So, eyes open, cats have good night vision, but we still don't walk into traffic. If you found this useful, a like helps the algorithm figure out that this isn't just random noise. And if you want to see more breakdowns like this, subscribe. I'm trying to build something here, one video at a time. Thanks for watching. DataCat out, and I'll see you in the next one.